As I mentioned earlier, my name is Debbie Phillips and I'll be convening the webinar today. And I'd now like to introduce you to Neill Colledge, who is our Head of Equities here at Millinium Capital Managers. Neill is responsible for our dividend income fund, which recently topped its peers in Morningstar's league table with a return of 31.2%. Neill has extensive expertise in securities with more than 30 years of using quantitative and qualitative methods to assess companies and industries in both stockbroking and funds management. It's my pleasure to now pass you over to Neill for his webinar, When China Sneezes, Australia Catches Pneumonia.
Thank you, Debbie. Once again, we're going to talk about China. This is not just because reading Chinese statistics happens to be one of my hobbies, but also because China is a very important trading partner for Australia. What we're going to look at today is specifically the coming China slowdown. We've seen in the last couple of years that China's GDP growth rate is dropping gently, not very fast, still way above Australian and the rest of the world historic rates, but it's falling. The reasons behind this are part short-term, part long-term, and the long-term factors are completely irreversible. There's nothing anyone can do about them. They include things such as an aging population, where you have more retirees, fewer workers, a rise over time in real wages, overcapacity in a lot of Chinese industries, which is being caused by long-term policies favouring investment rather than consumption, visible pollution, if you visited China, of the air, the water, parts of the soil, food and so forth, to the extent where one of the main things which Chinese tourists buy overseas is baby powder. Why? Because there have been scandals when Chinese-made baby powder has been tainted and it actually caused the death of some babies. Finally, the Chinese economy in aggregate has way too much debt. This is focused in a couple of sectors in particular, the corporate sector and the local government sector, but at a level of 200% of GDP, this is higher than the countries in Europe which had debt crises. Now, China is very important for Australia. It is currently buying 36% of Australia's exports, up from about 2% 25 years ago. 3/4 of these exports are obviously coal and iron ore. On top of that, China's economy is closely integrated with the economies of Japan, South Korea, Vietnam and so forth, in that finished goods may be exported from China, but they also use partially finished or goods or raw materials which were imported from other countries in East Asia. So if China slows down, then a lot of East Asia will slow down as well. And this is even more important for Australia because East Asia in total buys 55% of Australia's exports. We've already had a slowdown, as I said, in China's economy, and as a result of that we've had sharply falling coal and iron ore prices and the complete collapse of mining capex spending in Australia. There are no new mines being built, there's a lot of maintenance capex going on, but basically all mining capex has been put on hold. And the point of this is to make it clear that you don't need a crash of any sort in China. A simple slowdown is going to be very painful for Australia. Now in particular, I really want to emphasize we're not predicting a crash in China. There's not going to be a repeat of anything like the US housing crisis, despite what various American commentators say. First of all, the average Chinese home borrower has a loan-to-valuation ratio of only 30%. Many, in fact, have no debt at all. That's because for Chinese with savings, banks have been a fairly bad place to leave your money simply because the deposit rates, which you receive about 3 or 4%, are less than the typical inflation rate, so you're suffering a net capital loss. The Chinese share market has been a truly awful investment. It is now lower than it was 5 years ago. You're not allowed to take money overseas legally. So what happens is that the ordinary Chinese investor puts his or her money into buying a house or an apartment, and this has been a good investment for them. The average Chinese investor actually has very little debt compared to the Western world. And most importantly, the lending mechanism is still bank loans, i.e. the housing loans are on the balance sheets of individual banks. They are not tradable securities such as collateralized debt obligations, which can be shifted around from bank to investor in a pass-the-parcel game. We also want to emphasize that China is not going to have a rerun of the US banking crisis. The key thing to remember about the Chinese banking system is that these guys are communists. The whole system is run by the Communist Party for the benefit of the Communist Party. That there is no belief that private competition, the free market, will solve anything. The Chinese government, i.e. the Communist Party, controls the commanding heights of the Chinese economy and has no intention of letting go. In particular, the banks are run by senior Communist Party members who may have been bankers, but then they go on to being governors of provinces and regulators and so forth. That is, there is no private enterprise motives whatsoever in the banking system, because even the large purely privately owned Chinese banks are very closely supervised by the Chinese government. Secondly, there will be no crisis like the US, because although it is completely certain that Chinese banks will suffer large loan losses in the problem areas, as I mentioned, commercial lending and local government debt, the central government will recapitalize them, just as it did in 1999. It will make good their equity losses, so the system keeps on working. Just to emphasize, household debt is very, very low. This particular chart shows urban disposable income and the percentage which consumer loans and housing mortgages form a percentage of that. This is way below the West. Australia, for example, is still up around the 140% range. China is less than a third of that. If you want another statistic, then as a percentage of GDP, Chinese household debt is only 12%. Most of the West, particularly Australia, it's above 90% of GDP, i.e. the Chinese consumer is way undergeared, partly because until about 15 years ago they had no way of getting consumer loans, taking out mortgages and so forth. In addition, although people talk about the ceaseless rise of Chinese house prices and argue there's a bubble in Chinese house prices, this overlooks the fact that affordability ratios are actually falling. And that's simply because, although Chinese house prices have been rising rapidly, Chinese household income has been rising faster. When you have average growth of 8% plus over the last couple of decades, then the household is actually going to do very, very well. And just to explain this chart, the affordability ratio shown here is rather like a PE ratio, i.e. it's the price of the property divided by the income, and so the lower it goes, then the cheaper the property becomes in terms of what you can buy with your income. And as you can see, this is falling pretty steadily over 15 years. On top of that, China's banks are not like Australian banks in particular. Typical Australian bank has above 50% of its loan book in residential in various forms, either directly or in terms of personal guarantees, or in terms of loans to small businesses which are secured on a residential property and so forth. If you look at this chart, then it's very clear that mortgages are only 14%, commercial loans to developers and construction is only another 12%, i.e. only a quarter of the loan book is actually exposed to the construction sector. And that includes non-residential as well as residential. And you can find maybe another 15–16% which is sort of related to that. The bulk of the Chinese bank's loan book is to the government. Government at various levels, particularly local government, but also provincial governments and so forth. And as we've said, the Chinese central government and provincial governments are very, very solvent indeed, and they're not about to let massive defaults happen in the local government sector. So, back to property. What's been apparent over the last 12 months is that property prices are falling and construction volumes are falling because you can't shift the apartments. These charts make it very, very clear that prices have been falling quite steadily since early last year. There's no sign whatsoever they're going to pick up, and in response, developers are reducing supply quite dramatically. Mostly they're trying to get the existing inventory off their books. So what has happened is that because you've had about 2 years of aggressive property construction, you have an overhang. There's been an overbuilding of property, and therefore there's more supply than demand can take up. This, of course, is very easily got rid of. All you need is price cuts, and we expect price cuts of perhaps as much as 20%. They're already begun, underway, in terms of not just the official stats, but also the discounts which are now available in apartments in many cities. And this is not much worse than a normal cyclical downturn in the residential property sector. But because of the importance of property investment in the Chinese economy, it's going to have a negative effect on Chinese GDP growth. The key way it does that is not through prices, but through the reduction in construction volumes. There's no doubt that the overhang of residential inventory will clear, but it will clear at lower prices, and developers will therefore be producing much less new stock. Obviously, a fall of prices of 20% will lead to the insolvency of some small developers. The big developers, however, have been predicting this for some time, and almost all of them will survive. Again, this is a cyclical downturn. It's not the China housing crash. The long-term property prospects for Chinese residential property are still very good. As we saw, affordability has been steadily improving. On top of that, there is a long-term need to replace the pre-1990 housing stock, which, if you've seen any major Chinese city, is really awful. It's not merely small, poor quality, but often you have to share kitchens and bathrooms. Finally, there's the ongoing urbanization of China. Only 52% of China's population currently lives in cities, compared to rates of 60, 70, 80%. So this, over the next couple of decades, will continue to boost demand. But in the next 2 years, construction volumes are going to fall. Non-residential is even worse, but this is actually a hideously complex subject because there's not merely several different classes of non-residential, but China's a very big country with a lot of regional differences. Broadly, what you can say is that China-wide, local governments under the 2009 fiscal stimulus in particular overbuilt offices, and they built office parks on spec, i.e. no committed tenants, which is why you see quite a number of empty office parks visible in China. Commercial developers more recently also overbuilt offices and shopping centres, partly because they knew from the last decade that building worked, you could always sell them, and partly because interest rates were very low. What's happened is that in the last 12 months, the central government's campaign against waste and corruption has actually begun to reverse the demand for office space because central, provincial and local governments are under pressure to be efficient, not take bribes and so forth. In fact, the whole non-residential property side is actually bigger than the residential, and I regret we don't have the time to discuss it in detail, but I don't want to take up 2 hours of your time. So, as construction volumes fall in both residential and non-residential, the demand for steel will fall. 2 biggest constituents of steel are, of course, coal and iron ore. Now, all the other things which steel is used for will also fall. Obviously, construction equipment falls as well, and we can see how it's performed in the last few cycles there. People say sometimes that the government will respond to this downturn by providing more stimulus. Well, not only has it just said in the official newspaper, the People's Daily, yesterday, that it's not going to provide more stimulus, but if you look at what the central government is trying to do, it has a very clear direction, which is to slow down credit growth because it needs to do so. Sure, the little local governments, China has not 3 levels of local government we're used to in Australia, but about 6 levels below the central government and the provincial governments, which are like Australian states, but much bigger. In fact, just bear in mind here that the city of Shanghai all by itself has 24 million people, bigger than Australia. Beijing is not far behind, it has 21 million people, almost as big as Australia. So these things are very large indeed, the size of whole countries. But provincial governments are very much subservient to the central government. They're influential, they have a lot of fiscal power, but of course they have no monetary ability and they don't make laws. The ones who are really desperate are the little local governments running at the level of prefectural cities, which are typically a few million people, down to counties, townships, villages and so forth, which may only be a couple of 100,000. These are very much dependent on land sales for about a quarter of their income, so they need development to continue, and developers going bust or even reducing volumes are the last thing they want. But the local governments have very little power to change this. What will happen is that the central government will permit, and has already begun to, create means for stimulating housing development in certain cities and stimulating certain areas, but the central government is absolutely averse to having another big stimulus, because 2009 stimulus and its after effects are what got the Chinese economy into its present problem of more than 200% debt at more than 200% of GDP. So what you will have, and what you're already having, is incentives applying to smaller cities, favouring certain sectors and so forth, but not another big stimulus. So, simple arithmetic will tell you that because property is an important part of the Chinese GDP, for every 10% fall in property investment, you get a reduction in GDP growth about 1%. There, for example, I've chosen the marketplace sensitivity. All other brokers produce fairly similar numbers. And this means that in the worst case of a severe slowdown in property, you get a fall in GDP down to as low as 5%. I don't think that's going to happen in 2015, but it is out there. What's more likely is GDP in the realm of the high 6s. But for Australia, that's bad. In fact, it's going to give us our first recession since 1991. The direct impacts are obviously lower commodity prices mean lower export earnings. There will be volume increases, but you're talking of volume increases of maybe 10% per year versus price decreases. Well, prices are already down 30 to 40%, and there's absolutely no reason, if you look at the historical performance of commodity prices, why they can't fall another 20 to 30%. Obviously, this means lower company profits, lower company cash flow. Therefore, high-cost mines will be closed. There will be job losses in the mining sector and the services, the sectors which service mining. Second round impacts, we get a rising balance of payments deficit because our export revenue has gone down. This will provoke a fall in the A dollar. At the same time, domestically, you get rising unemployment, then slower GDP growth, which turns negative. Just as a point of history, every mining boom in Australia since 1851, Hargraves discovers gold, has been followed by a recession. Sectoral impacts, obviously mining is the worst. BHP and Rio are not at any risk whatsoever. Their profits will drop, but they are amongst the world's lowest cost mines, lowest on the cost curve. High-cost mines, on the other hand, will be shut down just in the same way as gold looked terrific at $1,800 an ounce. Down at $1,200, a lot of gold mines have already been shut. Mining services companies will respond by switching to domestic sectors such as infrastructure, or they will go overseas. Obviously, the resource states of Queensland and Western Australia will suffer first and most seriously, but broadly speaking, it is negative for Australia. Higher unemployment And lower exports means not just lower growth, but a fall in real living standards. We've done very well out of the mining boom over the last decade. Now we're going to have to give some of that back. The banks will suffer not so much through their exposure to mining, which is not large. Mining as a sector is not a big part of the Australian economy. But when there is a recession, when there is unemployment, people can no longer meet their mortgage payments. They go to the bank and they hand in the keys. Or they struggle on and they get evicted. So there will be loan losses on residential property and also on some commercial property. So what does the prudent investor do? Well, again, we like to look at things in the very long term. For a decade, it's been wonderful for the resource-producing economies, not just Australia, but also Brazil and Canada. The next decade, when commodity prices are low, is going to favour the resource-consuming economies, particularly the US and Europe. Now, I expect, as I said, the $8 to fall, but it's not going to fall enough to fully offset the China downturn, because we are still perceived as a safe haven currency due to the AAA rating. And in addition, we have a 200 to 300 points premium above rates, interest rates in the rest of the Western world. So there's still a reason for buying the $8 for yield. For the Australian investor, well, obviously you shouldn't own any mining-related stocks. You should own things in the US, certainly. If you're a little braver, Europe. And I must say that that's not a perfectly straightforward choice. I do personally have European exposure, but it's not for everyone. The simplest ways to do that are, of course, index ETFs trade on the ASX, companies listed on the ASX which have a lot of US operations, and of course Millinium's newly launched S&P 500 fund. So our existing Australian equities fund, the Dividend Income Fund, has been averse to China for some time and has done well out of that. We continue to be very averse to China. That is, we are long Australian companies which have US exposure. We're long Australian companies which will benefit from a fall in the $8. We have owned domestic cyclicals and consumer discretionary. We are continuing to reduce exposure to that sector as the recession gets closer. We are also monitoring the market closely for early warnings of a correction, which will not be domestically generated. It has more to do with the rest of the world, the US in particular, and global junk bond markets. And a new thing, as the banks have risen quite sharply in the last couple of months, we think they're now fully priced, and we are considering when we should sell out of them. So, that, in summary, is our views at the moment. Negative on China, but broadly in line with what we've been saying for the last couple of years. Please feel free to ask any questions.
Thanks very much, Neill. I'd just like to thank you for your valuable insights into the market, and it's definitely offered some food for thought on the future of the market in China. What we'll do is, whilst we just allow Neill to catch his breath and grab a quick drink, for those of you who arrived late, I'll just quickly go over again how you can ask a question. There's one of two ways. You can either verbally ask a question by raising your hand in the webinar console, at which point, once I see your hand raised, I'll turn on your microphone and we'll attempt to allow you to ask Neill a question audibly. If that, however, fails, we'll just get you to type the question in the question bar and I'll ask the question on your behalf. So, Neill, if you're ready, I do have a couple of questions for you. Now, the first one, I will apologise in advance. For those of you who know Marcel, you will understand the length of the question. For those of you who don't know Marcel, as I said, I will apologise, but it is quite a lengthy question. So here goes. Neill, given that increased pressure from the regulators in Western economies has led to a significant increase in the shadow banking system, particularly in the US and UK, do you think that the generally acknowledged gargantuan size of the Chinese shadow banking system poses more or less of a systematic risk to the Chinese economy than the size of the Western shadow banking system poses to Western economies?
Yes, it definitely does pose a much larger risk, because relative to the economy, it is large. We are talking about, obviously it's the shadow banking sector, so you can't measure it exactly, but we're talking about equivalent of about 100 billion US, which even for the world's second largest economy is a dangerous proposition. But there's an important difference in regulatory attitude here. The US, you recall, before the GFC and even now, has this firm belief in the magic of free markets, and probably in Santa and the Tooth theory as well. The Chinese government has no such belief. It retains a very firm grip on the economy. The shadow banking sector has sprung up, but the Chinese government has acted quite sharply over the last 12 months to, first of all, slow down its growth, secondly, to monitor what's happening, and thirdly, to rescue any problems which may be emerging. Earlier on this year, there were a couple of shadow banking products, in the so-called trusts, which were about to default. The investors were very concerned because the responsible entities had basically said, we can't pay you. What happened was that quietly and behind the scenes, the Chinese authorities arranged a rescue, presumably by getting the related parties such as banks and possibly totally innocent parties to lend part of their balance sheet to ensure that the investors in this would be paid out. So this is what is probably going to happen in the shadow banking sector. It will be regulated more closely. Any major difficulties will be overcome by the means of arranged rescues. Any minor difficulties, such as Chinese sold companies and small shadow banking products which don't affect a lot of investors, well, they're going to lose their money, and that's that. So yes, it's going to be a difficulty, but it's not going to cause the same sort of problems that happen in the US. And as I said, we believe the Chinese banking sector is going to have difficulties, but the government is firmly in control of this. There is not going to be a Lehman moment. Things will be tidied up forcibly if need be. So apologies for a very long answer, but I felt since it was Marcel's question, it was the least I could do.
I was going to say that's worthy of a Marcel answer, so thank you very much for that. We do have a couple of verbal questions to ask of you. The first one will be Damien, so I'll just click onto his microphone and hopefully we'll be able to get him to ask his question. Dame, are you there?
Thanks, Debbie. Neill, many commentators have said that China has a housing bubble which must burst eventually. Are you saying that there is no bubble?
Yes, we're saying that there is no bubble, because if you look at what a bubble is, it has to get to the stage where it's no longer justified by fundamentals. People are buying something, not just housing, but they're, for example, buying a house with the intention not of living there for very long, but the intention of selling it on for a profit in the near future. As we saw from the affordability charts, this is not the case in China. People are still buying houses because they are affordable. There are still long-term drivers. And therefore we think that there is not going to be a housing crash anything like the US. This is a cyclical downturn. It is going to be painful, particularly if you're a small developer. Many investors will be disappointed at the 20% price fall in their investment, but because they're not, they don't have 90%, 80-90% loan to valuation ratios, they're not forced to sell. This is not a catastrophe.
Thanks for that, Neill. We do have another written question, and then we will go to the other verbal question that we have for you. Mark's interested in your view on the following question that Martin Wolf posed in the Financial Times recently. And the question he posed was, is China different, or must its borrowing binge, like most others, end in tears?
Yes, Martin Wolf is absolutely right. Its borrowing binge will end in tears. But I emphasise again that its borrowing binge is focused in the corporate sector and the local government sector. And the borrowing binge is very well known to the Chinese government, which is not sitting back and hoping that the magic of a free market will take care of it. It is quite aggressively slowing down credit growth from around 20% a year. That was a real 20% a year. It's an extraordinary rate, down to below 10%, and it's keeping it down there. This is why we don't think that the Chinese government is going to provide a massive stimulus on the order of 2009, which was about 12% of GDP. what we think is going to happen, the Chinese government realizes it has a debt problem. It knows that it can grow out of this even if it has growth rates of 6 or 7%, and B, that these things can be managed if you keep a very firm grip on what the lenders are doing. And so we don't expect a disaster of the sort of the size of the GFC. That doesn't mean that we are absolutely confident in the Chinese government. It is always possible for governments to stuff things up. But at present, they are heading in the right direction, and they're probably going to manage to deflate this balloon rather than have it burst in their face.
Fantastic, thanks for that. We've probably got time for another handful of questions, so we'll toss over to or pass over is probably the more appropriate way to say it, to our next person, and that would be Amand. It appears that Amand may be self-muted. Now he's unmuted.
Hello.
Well done. Here we go. Okay, Amand, you're on.
Thanks for that, Deb. Neill, what do you mean when you say that Chinese governments will relax residence restrictions? Does communism mean that you need official permission to buy a house?
Not quite, but pretty close. Since the 1950s, the Chinese government has had in place a system of urban versus rural residence permits. And if you are a rural resident, then you do not have the right to get social services if you move to another place, such as a city. This means that for about 15% of China's population, which actually lives in cities but doesn't have the official residence permit to live there, they don't have access to education. Actually, they can't send their kids to the free city schools. They don't have access to health or other social services and so forth. This is what's called migrant labour. These people obviously have no way to buy a house in a city, or house or apartment in a city, and that's what I mean by residence restrictions. While many of the migrant labourers are in fact too poor to buy a house, nonetheless there's quite a proportion of them which could afford to do so, particularly in the smaller cities. Just on that subject, let me just note very quickly that when we talk about China house prices, we're talking about a range from very affordable in small cities to completely unaffordable in Beijing and Shanghai, where the affordability ratio is not 6 or 7 times, it's 20 to 30 times your annual income. So it depends where you are, and you won't see any restrictions on residents in Beijing or Shanghai removed simply because everyone wants to live there. But it's possible to stimulate demand by allowing rural residents to buy houses in the smaller cities.
Thanks, Neill. We actually have 2 more questions, and this first one is definitely one that I'm interested in your opinion on. RBA board member and HSBC economist John Edwards has just published a book saying that fears of the end of the mining boom are overblown. Now, clearly you don't agree with this, so what is it that you think he's missing?
I agree with John Edwards' thesis as outlined by him in the press and in interviews. I haven't, of course, had time to read the book yet. And his thesis is that Australia has actually coped reasonably well with the mining boom, and we don't have a federal budget crisis at the moment. What we have is falling revenues as a result of the tax cuts in the later years of the Howard governments and the various incentives handed out by the Labor government since then. The Australian economy is not in real difficulty at the moment. But what his book doesn't seem to cover, and is not intended to cover, is what happens in future. And it's certainly my view that when the downturn comes, it will be worse than Edwards is expecting, because the downturn has only just started. The key thing about every mining boom, besides there being a recession, is that the downturn is always worse than we thought it would be. It's always more painful. There are more mines closed, more companies going bust, more people out of work. And that, based on 150 years of history, is really our view that recession is going to be bad, it will be painful, and it would be best to be prepared for this.
Great. Thanks for that, Neill. Now, the final question we have, unless anybody wants to post any more, is that recent reports from China mention that there may be problems with some copper and aluminium inventories which have been used as loan collateral. Is this going to be another problem for China's debt levels?
Yes, it's definitely a problem. What happens is that there are always people who, in order to increase the amount of loans they can get from a bank, are willing to offer the same asset as collateral 2 or 3 or 4 or 5 times over. With something like a house or a commercial building, it's fairly easy to prevent this because you can put caveats on the title and so forth. If, on the other hand, you have several tons of copper or aluminium, well, there's nothing to differentiate that from any other several tons of copper or aluminium, and therefore if you have careless bankers, negligent auditors, then it's quite possible to pledge the same asset as collateral several times over. So there is no doubt that this has occurred in China, because it has occurred in every boom in every economy. Certainly it's become very clear that in the port of Qingdao a lot of assets have been pledged 2 or 3 or 4 times over, but this is not a big problem. You're talking about something measured in the tens of billions here rather than the hundreds of billions. So while that will be painful for the banks, it's generally under the problem of bad corporate loans, and it's pretty much taken into account. Yes, it's going to be a problem. It's going to cause headlines. The banks will lose money on it, but it's not an economy-shaking problem.
Great, Neill. Thanks for that. It's always interesting hearing your views on everything that's happening in China. It appears that that's the end of our questions. So on behalf of everybody who attended, I would like to thank you for your presentation today. It has been very, very valuable. And I'd also like to thank everybody else for attending the webinar. A copy of it will be made available to you tomorrow via an email link. So I'd like to wish you all a wonderful rest of the day, and thank you very much for attending, and we look forward to seeing you at our next webinar. Thank you.